It's an interesting week because we are going to start to get some earnings out of some of these software companies that have been beaten down, Salesforce, Workday, a few others that I'm forgetting here. And it gets to this idea as to whether, I guess, the sell-off that we've seen, effectively a bear market that we've seen in a lot of these software names, is warranted, or are people just kind of getting maybe a little bit too ahead of themselves with the pessimism?
Well, I mean, I think we have to start with a baseline that maybe some of these software companies did have very high multiples, around 30 PEs. That's got trimmed back down to around 15. So I think there's been a reasonable sell-off in the overall space. But I think the way the market is looking at this is they're thinking about this as something that could become a systemic event or something like that. I don't see it that way. So effectively, whenever I see an event like this is one sector in the market that's moving, I always ask the question, is there a contagion? Or is there a dispersion, in which case I can diversify the risk? So is this sell-off in the software sector, is that infecting the credit markets? Is it infecting liquidity? Is this going to become a leverage issue across a broad swath of sectors in the markets? We're not seeing that. In fact, we're seeing the publicly traded credit markets are trading just fine. Liquidity is just fine. So I do think that there has been a setback from high valuations, but I don't see the contagion. So I don't really see this as a broad-based sell-off with a long gestation period that could bring down the market substantially further.
What do you think people are looking for, though? I mean, I understand valuation is part of it, but there's something more there.
So look, I mean, I think people are really trying to evaluate the creative destruction that's coming out of all of the various, different large language models and what have you. And what people I think are misunderstanding in this whole thing is that there's also an opportunity set that comes out of this too, right? So there's probably a lot of future jobs that we can't even think of today that are going to be there for us. But this whole idea of this halo trade, this heavy asset, low obsolescence, well, yeah, I would like to invest in things that have low obsolescence, but I also want things with a high growth rate. So how do I get something with low obsolescence and a high growth rate? Well, yes, if you have a very unique product, fine, but there aren't a lot of those. So in general, if you invest in a lot of things that are not subject to creative destruction, then you're probably not going to have a very high return on your capital either, right? Because the growth rate just isn't going to be there. So I think people have to understand that creative destruction, and with all this AI stuff that's going on, effectively get used to it. It's going to disrupt a lot of things. The question we have to ask ourselves is it disrupting areas that have a lot of leverage that will then create contagion across markets? If not, then we have to figure out ways to construct our portfolios and manage around it.